We're joined live from North Carolina by Geoff Dennis, who's independent emerging markets commentator. Geoff, thanks so much for taking the time. I'm curious about what you think, because there was a bit of a slip of the tongue by the Fed chair when he was talking about there's no increased risk of a recession, and then he corrects himself to say a downturn. The question that a lot of observers will probably be asking is, if there was no elevated risk of a downturn, then why a 50 basis point cut and why not a smaller cut?
I was a bit surprised personally. I thought they would probably cut by only 25 today, so I'm not the best person to ask, I think. But I think the answer here is that after a very, very sharp upcycle of interest rates, they probably wanted to get this cycle moving with a nice cut and then set up a whole series of smaller cuts. In other words, begin with a bang, if you like. But I also think it reflects two things. First of all, the inflation data has got remarkably better in the third quarter. So it does give them the room to take out some more insurance against an economic downturn, because we're now at 2.5% basically on the PCE price index and on headline inflation, heading towards 2. And although the economy does look okay, the labor market has weakened. And so I think you treat it as the start of a Fed funds cycle, and it's a bit of insurance that the conditions for lower rates are better than they were obviously 3 months ago.
Okay, I will ask you about equities, but I'm curious what you think about the other asset classes, because there have been certain comments about credit becoming more attractive with the rate cut. We saw gold prices hit an all-time high in yesterday's session, overnight as well, before coming off very slightly. What do you think about that, as well as the dollar? Where do you think that is headed?
Well, some of the price action would suggest the markets are a bit concerned that the 50 basis point cut is too much and does at the margin raise the risk of some uptick again in inflation. Gold doing very well. The bond market basically not reacting at all. You haven't seen any any decline in yields on the back of the Fed's decision, although of course 2-year rates have come down. I think that although the dollar did fall this morning before the Fed's decision and did fall further immediately after the Fed's decision, it's rallied a little bit over the last few hours, clearly. So the dollar's a bit confused as well. Now, I truly believe, and I've said this many times on this show, that if we are at the beginning of a pretty big interest rate cycle, and I think we are, and the Fed's mapped that out, you know, with interest rates down to 3.25 to 3.5 by the end of 2025, ultimately that will bring the dollar down significantly. And I think that's good for equities, but I think in particular, it's very good for emerging market equities.
Fantastic. So that sets up the perfect question. How do you look at India in the context of where we are right now? We've got more clarity than we did perhaps a month back. But a lot of people are saying that India is expensive where it stands right now. What is your opinion?
India is always expensive. And I think that I personally still like the story very, very much. There's a lot of conversation out there about, is it time to rotate from India into China? The answer to that, in my opinion, is absolutely no. It is not the time to do that. India and Taiwan have been the big drivers of what gains you've had in emerging markets this year. I think the lower dollar, if we get that coming through, will provide a little bit of support at the margin for the rupee, which has ticked up a little bit recently, not by much, of course. But also the other thing we've not discussed here is oil prices have come down a long way, which is also very beneficial for investor sentiment towards India. So I still really like the India story. The growth backdrop is good. The earnings numbers, of course, are, as ever in India, somewhat patchy. But I don't think there's anything to worry about valuations here today that we should have, you know, when we didn't worry about them 3-6 months ago. And in particular, I wouldn't do much rotation out of India into other markets like China at this point.